Yeah, hi folks. Clint Taylor here from the Property Investor Centre. And today we're going to be talking about property finance, specifically non-bank lending. So as many of you are likely aware, over the last couple of years, we've seen the main trading banks in New Zealand, tighten up or restrict their lending criteria. So this has come about by two things, really. So first of all, the Reserve Bank in New Zealand, them introducing their LVR restrictions. So as most of you are likely aware, in New Zealand currently, we can only borrow to 70% loan to value ratio, where in the past that's been higher. So that has tightened up what we can do and limit the amount of borrowing that we can take against the equity that we've got. Okay, so the second reason for the trading banks tightening up their lending policy, I think, is to do with the Royal Commission of Inquiry into a lot of the misconduct that was happening in the banking industry across the ditch in Australia. And with the majority of our trading banks in New Zealand being Australian owned, it's only natural that we've had a flow-on effect to our banking industry here in New Zealand. Okay, so over the last few years, there has been, more and more demand, particularly from residential property investors, for other types of non-bank lending product. So today we're going to be talking about a new non-bank lending product, which is very well suited to residential property investors here in New Zealand. And that product is brought to us by the people at Bluestone Mortgages, and the product is called Select. So a little bit of history on Bluestone. So they first entered the market with non-bank lending in about 2002. And I've used them myself in the past as I was, aggressively building my property portfolio a few years ago. Post GFC, a lot of that non-bank lending basically dried up and went away. And it wasn't until I think it was about 2017 that Bluestone come back into the New Zealand market and was offering non-bank lending. Okay, so more recently, a few people have got together and they have put together and designed this new Select lending product, which in my eyes has a few key advantages and major benefits for residential property investors. For a start, they're not governed by the Reserve Bank's 70% LVR restriction. So they're happy to lend up to 80% for investment purposes, LVR, and up to 85% on owner-occupied dwellings. Okay, they also have a different view, and they look at the debt service criteria slightly differently to the main trading banks as well. So there's some major advantages there for some groups of people, particularly self-employed people, which I think is a pretty big deal. Also, they're quite happy to do equity release against equity in your own home that you can then go on to use for investment purposes. Some of the main trading banks are being a little bit restrictive on that front these days as well. They're also quite happy to look at doing interest only for up to 5 years for investment lending, whereas some of the banks are being a little bit tight on that. And there's certainly a lot of the main trading banks are not rolling those interest only periods over when the term is up. Okay, so as long as the way that Select look at it, they're happy to do interest only for investment purposes. And as long as you've been making your payments and basically being a good customer, they're quite happy to roll that interest only period over for, say, another 5 years. Okay, so that's a big plus as well. Now, also they will take different types of income into account in the debt service calculation as well when they're assessing your ability to qualify for a mortgage. So if you get paid any type of bonus or commission component over and above a base salary, a lot of the main trading banks won't take that into account. But Select, the lenders at Bluestone with the Select product, they will take that into account. Also things like child support payments. That can be a considerable component of somebody's overall household income. and the main trading banks generally don't take that into account into the debt service calculations, whereas Bluestone through the Select product will do. Okay, so there's some real key benefits, of us as investors working with a non-bank lending product like this. Historically, these products have been available, but they've come at quite a premium or a higher interest margin above standard bank rates. That's now no longer the case. There's a small premium there, but it's not great. In most cases, the way that I look at these things is, if using a product like this is going to enable me to buy a property or get into a deal, where I'm making equity or, buying a quality property and getting good cash flow out of it, etc. If using a product like this or a non-bank product enables me to get into that deal that I wouldn't normally have been able to get into through standard bank lending, and the interest rate that I have to pay or the fees that I have to pay still works, well, then it's a good thing. And that's the simple way that I look at these things. Okay, so now I'm going to cut over to Kris from Kris Pedersen Mortgages, and he's going to interview Peter Wood from Bluestone, who are bringing us this new Select non-bank lending product, and they can tell us a lot more about it. Okay, thanks, Kris.
So the new product he's launched, Select. How are you, Woody?
Very well, thanks, Chris.
So can you just give the listeners a quick, I suppose, intro into your background and I suppose how you're here today?
Sure. I'm a Kiwi by trade, so born and bred here, but if I speak like an Australian, that's because I've lived in Australia and have done for the last 14 or so years. But my background is essentially in the non-bank market, and I started one of the first non-banks in New Zealand about 20 odd plus years ago. And have remained in that sector both in Australia and New Zealand since. I started Bluestone in New Zealand in 2002, and now we're back into the market again as of 2017, so done the full circle.
Fantastic. And one of the things myself and other advisors are getting asked a lot is the market going to relax over here, especially in the bank space? And we're hearing a lot about what's been happening across the ditch in Australia, which I'm sure you're more aware of than anyone. Can you give everyone, I suppose, a bit of an idea on how much the Royal Commission, over there has tightened things over in Oz?
It is certainly it's had a big impact. If you look at the non-bank growth in the market in the last probably 18 months in particular, there's been a big spike in non-bank lending. Primarily because of the Royal Commission. So the bank's going through a series of tightening of credit criteria. Some of that is related to the Royal Commission, and some of that is just a general tightening in the market. With the property market being a little bit bumpy in Australia, there is some uncertainty around that part of the market. But the Royal Commission has certainly lifted the lid on the banks, and they're going to spend a number of years working through a number of compliance issues, and the fact remains that that will in itself tighten the criteria moving forward, and we expect that to continue. There's no sign of it sort of slowing down at the moment. I think there's a flow-on effect to the New Zealand market as well. Obviously, the major four banks here are owned by Australian banks, so there's a natural flow-on effect to the market here. I think, and that will continue as well. And I think it'd be fair to say that we've already seen a fair bit of that going on in the market. I think there's other things in the market here which will increase the size of the non-bank share. Things like the capital regimes that the banks are going through with the RBNZ and the regulators. I think that'll have an impact on the market as a whole. But I think you'll see a funnel of the messages, I guess, tightening will continue.
Yeah, I mean, are you seeing interest-only loans still very tight over in Oz? Or probably a better question, I'll rephrase it, is it still very hard for people to roll interest-only loans? Because it's definitely been quite tight over here with the banks. We're getting more and more people who are expecting to get rolled, who are suddenly getting forced onto P&I.
Yes, there is that element to the market, and there's no reason to think that will not continue into the future. We do see it pick up a lot of business because of that factor in Australia, and we see a similar sort of stance here as well.
So with that in the general political environment, obviously we've seen here ANZ getting whacked for being a bit naughty over the last couple of weeks. Do you expect them kind of to see bank funding getting any easier anytime shortly?
No, I think it's going to get harder, and I think there's already signs of, as you would know, of that in the market already happening, and I think that will continue for the foreseeable future.
So then on to Select. Talk to me, I suppose, how that product line came about.
It's something that we have been discussing for a while, and when you look across the market, there are a number of aggregators in the market, one large one and a number of smaller ones, and we felt there was a gap in the market for to partner up with a good group and provide a product branded that targets certain sectors of the market which were not being catered for, and primarily talking about things like the investor market, where the RBNZ rules prohibit banks from lending over 70% LVR. So when we looked at the market as a whole, we wanted to create a product that targeted certain sectors, but also partner with a group that we felt could provide the distribution footprint.
So Select effectively has four, I suppose, what we call different products. They've got Prime, Near Prime, Specialist, and Specialist Plus. Just want to ask a few questions about the range. Is it fair to say you'd expect the majority of what Select writes to fall in the Prime?
I think so, yes. We would expect probably 80% of our business to fall into the Prime and Near Prime sort of bucket, and then the Specialist Plus make up the remainder.
And that kind of Specialist Plus area, is it fair to say that the main probably difference in criteria from that and maybe the more Prime products is more around the credit area?
There's two areas, but primarily the one is credit rating of the borrowers. What most people don't know, and the figures are not that readily available, is that 1 in 4 people in New Zealand actually have some impairment on their credit record. So when you think about the population, the working population, that's quite a massive market, and so that's why these types of products exist. Another key area is around the self-employed market, where we have specific products to cater for those types of borrowers.
Yeah, I suppose in our client base have definitely probably tended not to find too many clients, but maybe substantial defaults or collections on their actual credit checks. However, something which I'm seeing more and more is maybe people getting caught from things like tax bills. We've had a couple of actually very high earning clients within the last month who kind of are used to, and they're people, high incomes, high asset bases, probably used to spending money, got a little bit out of control, think they can go back to the bank and kind of know banks don't tend to like tax too much, and so their view is probably their credit's fine, but banks tend to look a bit harshly on that tax aspect, where you guys are a bit more amenable to look at that.
Yeah, I think it's a circumstance of some and quite a few borrowers out there that they don't have all their affairs in order in terms of when taxman comes and knocking at the door, and so we've got no issues with incorporating or refinancing or paying out that tax debt. It comes down to serviceability. If the borrower can service it, then why should it's no different than refinancing or paying out any other debt.
100%. Yeah. From a price point of view, obviously it goes from Prime at the cheap end, shall we say, through to that Specialist Plus, where prices or interest rates are a little bit higher. Do you see customers progressing through the different products while maybe still staying with the Select brand, where they might maybe even using that maybe particular client we talked about before, who may have had a tax issue, which maybe put them in there, they get cleaned up and can maybe kind of over time transition to the Prime product with cheaper interest rates and things like that?
Yeah, that's certainly an option, and I think the basis of how we view that is centred around repayment on a monthly basis. Have they made all their repayments? Have they made them on time? If the answer to that is yes, then you want those kind of borrowers to hang around longer, so you'll actually look at the reduction of interest rate from those different products through the product line.
And how about loans for business? Obviously, this would be, when I say for business, actually taking residential property as security rather than trying to lend on the business itself. How do you see that as a reason for borrowing?
Absolutely fine. There's no issues with that. We do that routinely. Again, it comes down to serviceability factor. Whether they're wanting, as an example, to couple $100,000 out as working capital to put on their business. That's what I guess Bluestone's original products were designed around, those types of borrowers. And there are a lot of them out there in the market that exactly require those types of loans.
And unlike banks who suddenly they're going to classify it as a business facility effectively and charge line fees or higher interest rate margins or all this because they're going to classify it, even though they might be taking residential security, your interest rates don't change there, do they?
No.
My understanding in regards to, dealing with you, I suppose, in comparison to the banks is the main cost is probably maybe a valuation. Is that kind of, obviously the banks sometimes can lend without that, that's probably the main additional cost?
It is, I guess. Our position on that is we're more prepared to take a punt on the borrower.
Yep.
Our fallback position is obviously the security, so we want to know that it's in a part of the country that has a liquid property market if we ever needed to realise on that property. So that's the philosophy around that.
And probably just finishing off a few questions we get asked often from property investors. So, you've got people who will look to try and create equity by buying at a discount or buying and renovating and things like this. If I'm buying a property and renovating, how long before I can actually top up against the valuation?
6 months.
Cool. And I suppose overall, how do you feel about interest only?
Interest only, at the end of the day, whether it's P&I or interest only, it's a feature of the product. We've got no issues with people having, in our prime product, for example, and near prime, we allow interest only on owner-occupied. Sometimes it's required to meet the borrower's requirements for a period of time. On an investor basis, we're very comfortable with having interest only for 5 and then potentially rolling it for another 5 years on top of that. So.
And so you just mentioned the owner-occupied side of things. Fundamentally, if the borrower wants it, it's fine.
Yes.
Yeah, so that's a very different point we're seeing with the banks. We've had a lot of pushback on that point in particular over the last 12, 18 months. Often clients from a tax structuring point of view may hold some investment debt on their home. Makes sense to be interest only, and the banks are creating quite a bit of difficulty there. And what about if they're wanting to roll it over? So, you tend to do, I believe it's 3 or 5 year interest only terms. Clients made all their payments. We're sitting here in 3 years as an example. What's that process like?
Yeah, again, that process comes down to we're more than happy to look at rolling it over. There's no issues with that. In terms of the process, it's just a variation of the transaction, really. There's nothing really required. Depending on the LVR, we might get an updated valuation or something like that. Yeah. We might get the borrowers to verify that their circumstances haven't changed in the last little period. But other than that, it's a fairly seamless sort of process to go through.
Equity release has got a lot harder when dealing with the banks over the last 2 to 3 years. Obviously, the term responsible lending's become pretty vogue across the industry, and where there used to be a bit more of in my opinion, a common sense approach where you especially look at some clients who have got high net worth, high incomes, are obviously intelligent people. They should be allowed to maybe do a little bit with their assets as they want. The banks are now making it very painful to try and get anything outside of quite small amounts of capital out. What's your position on this?
We're very flexible on this. So, as an example, our prime product is equity release up to 500,000. Obviously we want to know where that money, they intend to use that money, but we're not going to put them through the ringer. It makes sense. As you say, it's a common sense approach. As long as you can get comfortable with what the borrower is telling us, then there's no issue.
Yeah, I'll definitely say from my experience, the process is, from what I've seen with applications so far, it's been a lot easier than what I'm finding at bank level. In regards to discharging securities, something which we've seen over a recent period of time is that where banks are hurting some customers is that bank criteria is obviously a lot tighter than what it was 2, 3, 4 years ago. And so the banks maybe lent to clients. Standard bank policy, of course, is they cross-secure all loans and securities together. Clients may decide to sell off a security for whatever reason, They don't want to give their hands on capital for any particular reason, and banks are re-qualifying clients at that stage there, and if they don't meet new bank criteria they're often taking all the sale proceeds and applying that to residual debt. Are you cross-securing the securities?
No, we don't. So, I mean, most of the stuff we do is on a standalone basis. There are some circumstances where obviously you'll have more than one security supporting a loan, but again, you take a common sense approach to that if one of them is discharging.
In most cases, would it be fair to say that it'll be closer to old policy where if you've got a couple of securities, client's account conduct's been good, they decide to sell a security, you'll be looking at the LVR position of the remaining property and going, does this meet criteria? We're allowing you to go through that rather than having to go through the complete ringer.
100% right.
Yeah. Now, interest rates, you're definitely happy. I think we had to talk about a year ago, and we're expecting to see the interest rates in the sixes, and so to see them kind of starting in the fours has been absolutely magnificent. You've got the matrix, which obviously rewards lower LVR loans. What was the thinking around this?
Our philosophy on that is that it's purely based on, we think, all lending should be risk-based. So, as an example, somebody borrowing 50% of the value of a property and somebody borrowing 80% of the value of the property cannot be fundamentally the same risk.
100%, yeah.
So that's our philosophy behind it, and we stand by that. And, we believe that's the way all lenders should price.
Yeah, 100% agree with you there. So while my belief is interest rates aren't likely to go too much lower here, there's a huge amount of talk in the press about the LVRs and all of this. I probably think from bank level, even if we see the OCR drop, the capital adequacy concerns, if anything, are maybe more likely to push interest rates up over time. Would you generally expect rates to follow the kind of basic direction that, when I say rates, your select rates to follow the general direction that bank rates go on?
Yeah, I mean, one of the interesting things is, we do obviously take notice of the OCR, etc., but that's not, our benchmark. We take our lead sort of indicators from the BKBN, which is the 90-day bank bill rates, and there's no doubt that they've, in the last week or so, they've been trending down. So I think there probably will be another shift downwards in terms of the OCR, and we would more than likely move alongside those movements.
And just one other question in regards to rates. Lots of people, it's quite common these days for people to want to know around things like break fees and stuff like that. The formula behind it, whether you're dealing with banks or non-banks, is exceptionally complex. I don't want to get into here, but basically reasonably the same as the banks. Yeah,
there's actually a prescribed format which we could talk about for hours and trying to work it out, but it is essentially the same format.
Well, thank you a lot for your time. Definitely think you're going to be getting a lot of business. I know you've already been flooded in the first few weeks of business. We've been putting in applications and are expecting to put a lot more in, so thank you a lot for your time.
Pleasure. Thanks for having me.
Okay, that's all with Woody. He's had to go. He's had some prior engagements to attend to here. I suppose getting into the select product a bit more, I suppose now some of the nitty-gritty and what we want to discuss, the real, I suppose, pros that the product range offers. Firstly, I suppose talking a bit more about the non-bank market. Peter commented before, especially over in Australia with the Royal Commission, how the effect that has had on the banks over there has increased the market share in the non-banks. This is how the non-bank market in New Zealand has looked over the last 10 to 15 years. Starting off with where this red arrow is, roughly a bit over 3 years ago, what was basically the low point in the non-bank market. What's happened since then, as we've seen banks tighten, is that the non-bank market share increased by about 78% between the start of 2016 and the start of this year. Still, however, is only a minor amount in comparison to back roughly just before the global financial crisis in kind of 2007, 2008. That decimated the non-bank market in a lot of ways in New Zealand, and as you can see, it's not grown back. However, in other talks I've had with Peter, the amount of, shall we say, financial grunt that the funding lines they have behind them is going to mean that they can definitely play their part in increasing non-bank mortgages up to and past basically what we saw a touch over 10 years ago. So mainly I'm going to be talking to the property investor market tonight, and in regards to investment lending, what do we need? And I've got Ryan here, so I'll get him to jump in and help a little bit as well.
So I suppose looking at probably the demand for what we're seeing across our client base and investors as a whole is that we're looking ideally for some higher LVR investment loans for our larger investors. You've got people who are in situations where they have large portfolios, but because they've reached their maximum capacity due to the LVR restraints, there is the demand because people want to buy more, but also probably they have the equity to do it if they can get up to higher LVRs than the banks are allowing them.
Now, next point is the easier affordability criteria. I'll talk more about this shortly. I've been talking for quite a while that, in my opinion, this is the part which is holding property investors back the most. Lenders are using very, very high test rates, and on the back of the Royal Commission, there's other parts of the affordability criteria that they've toughened their servicing around as well.
We also find that across the market, self-employed clients, particularly when the credit market tends to contract, we have situations where bank policy can be very, very rigid for self-employed clients who are actually good borrowers. And so having different options available outside of what banks require in terms of documentation does open a wider market for some of our clients.
Interest only mentioned, I suppose it was raised in the interview with Peter in regards to how we're seeing the market, in particular with the banks, and especially for cash flow, people's ability to continue investing. A lot of investors do want interest only.
And I think the key thing as well is having all of these things at a reasonable price, because non-banks have played quite a large space, particularly over the more recent years, as Kris had mentioned previously, but in some cases some of the pricing can be not as attractive for buy and hold investors.
So going to get, I suppose, into some of the benefits now that Select in particular offers. Just want to make it very, very clear that while we're talking about Select tonight, we are doing a lot more non-bank lending across the board. I looked at my personal pipeline for August, and in regards to the deals that I've got basically due to settle, 42% of them are actually looking at being non-bank funded. If I look probably kind of say 18 months ago, I would be surprised if I was doing more than say 10 to 15% at that stage. So with the tightening in the banks, that's meaning a lot more people are looking at the non-bank market. So while we're going to be talking in particular about Select tonight, be aware there's a lot of other funders that we're starting to use. If you don't fall into the Select basket, it's still worth having probably a talk to us, and we've got other options out there. So first point I suppose to talk about in regards to what they offer is what we call higher LVR investment lending. We know the banks are mainly capping this out at 70%. So a bit of a talk here in regards to what Select can do.
So on the investment side of things, Select are willing to look at doing up to 80% on an investment property. For borrowers, they're allowing lending up to about $3 million as a maximum per client, but that comes down to having a maximum of $2 million per security. So if you're trying to target the maximum borrowing space, what you need to do is obviously offer more than one security to be able to reach that $3 million figure. But for investors with larger portfolios, this definitely can be an option and allow you to leverage further than what the banks are currently doing.
So one other key word on that slide as well is standalone. You'll see 80% standalone investment lending. I just want to make that really clear, because some of the other what I'll call prime and near-bank offers are doing is they require you to also give the family home. In this case, Select's quite happy to lend to 80% as long as you meet their remaining criteria without having to give that.
One thing, while we are focusing on investors, something worth noting as well is Select do 85% lending on owner-occupied properties. So just keep that in mind.
So here's a bit of an example, a client who's restricted by equity. They want to get out there and keep moving forward with their investing. This is an actual client of mine, a particular client sitting there. They've got one rental property worth about $460K. They've got a $345,000 bank mortgage, so they're 75% geared, and they want to keep moving forward. Now, this particular client also had $55K in cash, and they want to keep investing. Now, the options, I suppose, that we ran through with this particular person was as follows. Option 1, we can look at bank funding. Because the investment properties already get above 70%, there's nothing we could do there. So we could take the cash used as a 30% deposit. They could go out to the market and see if they could buy something for up there to their 183k mark. Unlikely. Option 2 is we use a non-bank using just the cash. So we leave the existing investment property where it is. So taking that 55k cash, using that as a 20% deposit, means they could go to a $275,000 purchase price. Option 3, we look to refinance the existing property from 75 at the bank to 80% with Select, which releases some more deposit funds. We combine that with the cash they've already got, and that would then enable them to go to a max purchase price of $390,000. So you can kind of see these different brackets, and this is becoming quite common to run through these different scenarios with clients. Obviously, all of you have got different positions to look at what you wanted to achieve. Obviously, we're going to be looking at cost and the most efficient way of arranging that. But you know, this provided a reasonable solution for a client who was looking down the line himself. This particular case also is worth mentioning that they were on principal and interest, and while the interest rate here was a bit more, 5.09, what we were able to do is change their payments from P&I over to interest only, which actually meant the payments overall were reasonably similar.
Across the board as well, what we're seeing, as Kris touched on earlier, is that bank assessment criteria based on people's affordability for new loans has gotten significantly harder than what it once was. That comes down a lot to probably some of the test rates that banks are using. When they look at assessing you for lending, they're probably somewhere between the 7 and 8% mark on a principal and interest basis. And when you're comparing those payments with what they actually charge you, when you've got rates in the high threes for the most part, the difference between how a bank looks at you and how you look at your own position and what you can afford does tend to have quite a disparity. So what we're tending to see with someone like Select is, because their loan affordability criteria is a lot easier than what banks look at, we end up in situations where you can actually borrow a whole lot more through someone like Select than you could through a bank lender.
So this is just a quick screenshot I stole off interest.co.nz. Good area or good website to go to if you were after kind of some financial information. Article, as you can see, was taken a little while ago, actually roughly about a year ago, and you know, mortgage brokers at that stage were estimating people's borrowing capacity had dropped 20%. I would say since then that's probably back about maybe another 10 to 15% with changes we've seen in regards to affordability around things like the Royal Commission and other changes there. Now, just want to run through some really key points in regards to the affordability. This is a test case which we actually worked on with Peter Wood over a period of time. We got access to a lot of the other lending calculators, and so what we were looking at is using some test cases where we were seeing what a client could borrow through some of the main banks. We were looking at both the main big Aussie banks and also the smaller New Zealand banks, and seeing what they could borrow through those funders in comparison to what they could get through Select. So here's a smaller investor, you know, a couple with 2 kids, 100k household income, a little bit of additional border income coming in, $500,000 mortgage on their home, wanted to get into the market and get their first investment. So what we've got here is the main banks and Select Home Loans. Through the main lenders, as you can see, they were capped out, couldn't borrow anything. Through Select, they could get, it was actually a touch over the 600,000 mark. So a good solution for someone who otherwise would not be able to borrow. Going into the larger investor space, similar household, couple with 2 kids, large, you know, household income, best part of $500,000 a year of rent. They had $7.3 million of debt on P&I. And a little bit similar, all the main banks this client's been tapped out with. This is quite a close personal friend who we used as a bit of a test case, and with Select, this client could actually borrow over $2 million. It was actually looking like it was the best part of about 2.5. So some quite you know, good capacity from there for someone who's actually capping out. Now, this is a test suppose, profile, someone who's theoretical, which I've created and used, I suppose, in a lot of talks, and want to show you here how a client looks at their numbers, how a bank will look at their numbers, and then how Select will look at the numbers. And if you can really concentrate on the difference between the bank and Select here. So let's say we've got an investor called Bob. He's got a rental income coming in of $120,000 per annum. What the banks do in most cases is take about 75% of that, or $90,000 per year. Bob's got a couple of $1 million of actual debt at an interest rate of 4%, and that's on an interest-only basis, so he's paying $80,000 a year. However, what the banks do is they take that $2 million, they use high tester assessment rates, quite often close to 8%, and they assess on a principal and interest basis, even if the client, in this case Bob, is paying interest-only payments. You stick that through the calculator, and it says about $173K per annum, obviously a long way above the $80,000 he's actually paying. So Bob's position is that he's got a nice positive cash flow portfolio. Understand he's got some expenses to come out there, but overall it's looking pretty good. In the bank's eyes, he's running at about $83,000 loss. And this is the big issue, which is hitting people who've already got so much surplus left over from our jobs or businesses to cover these losses and be able to continue investing. Now, Bob's position in regards to his cash flow obviously doesn't change, but let's have a bit of a look at how Select are calculating the servicing. So they're taking 80% of the rental into consideration. Next point is if the client, in this case Bob's debt, is on an interest-only basis, they're using an assessment rate of 5.8% and assessing it on principal and interest over 27 years. So that test rate is still markedly lower than what the banks are using. So as you can see here, there is still quite a large difference between Bob's view and Select's, but if you look at the previous slides, it's still a lot better than what the banks are doing. Now, when we're looking at clients, there's another technical aspect which, if you're hitting brick walls still, we can potentially improve things further. In this case here, Bob's debt is actually on principal and interest, rather than interest only. If this is the case, and this is the existing debt, which is with other lenders, when we go to Select and look to basically borrow more money, what they will do is they will use the actual payments, rather than the previous situation where they're using a higher qualifying rate, the 5.8. In this case here, because Bob's existing debt is on principal and interest, they will use that. And as you can see here, the difference between Bob's cash flow and Select's cash flow is a lot closer.
What's worth saying as well is that if you have a situation like this, the size of the negative, although, for example, in Select's position, we're not quite yet at a positive, Bob's earned income can help to offset this. When you go back to the first example from how a bank might look at you, it might be very difficult for personal income to help offset some of the losses that banks are looking at.
So a real key point here, and this is getting for a little bit more technical, is we're finding a lot of people, especially those who've got larger portfolios, are sitting here going, we feel our cash flow is fine, even though we know the bank's calculators are saying that it's not. And a lot of people are actually happy or already do have some of their debt on principal interest. So what we can do in some situations is turn maybe some residual debt that you've already got with existing bank lenders potentially over to principal and interest if you're feeling okay about your affordability, and that will increase the way Select is potentially viewing your affordability and enable you to borrow more. This is where we need to kind of get into a complete review to make sure we're setting this up properly for you though.
What we're also seeing a lot of in the market is as credit tends to get a little bit tighter, we do see banks a lot more harsh on self-employed clients, particularly things around bank income verification requirements, but also probably how banks are looking at self-employed clients in general. So in a lot of cases, banks won't even look at an application unless the client has 2 years full financial statements prepared by their accountant if they're self-employed. Or in other situations, what we have is banks tend to look at averaging out the last few years of a client's income as opposed to probably looking at more recent years, even if there's merit and reasons for doing so. For example, changes to the business or seasonality or things like that that may affect performance. What Select have is a great product where typically their requirements can be a lot less harsh than bank criteria. So for example, instead of maybe requiring 2 full years of books, what Select may look at doing is using 6 months business bank statements with their accountant's letter template or 6 months GST returns. So for example, having options like this does tend to mean that instead of banks averaging out or looking at 2 full years financials, you can get away with a lot less. In addition as well, banks typically are requiring full financial statements to be completed for the most recent financial year. And it's only August at the moment. Sometimes banks are requiring full 2019 year financial statements and clients don't necessarily have those done. So there are options where Select will work off less documentation than banks are often requiring.
So a bit of an example on a transaction we've already had approved through Select. This particular client was self-employed. They actually were currently with a more expensive non-bank lender, paying an interest rate kind of circa 8%. They managed to get a really good buy and hold. We're happy to pay that for a little while to acquire the property. Issues in regards to proving their income meant that they couldn't refinance it over to bank funding. This particular person, their income had been a bit all over the place in regards to some personal life situations that had been going on. And so the banks just basically weren't happy to look at it at this stage. So what we were able to basically do is refinance them over to Select, who used more limited information. And what they did is use the documentation requirements that Ryan alluded to earlier. They were also able to release some of the unutilized equity that was actually still remaining in the property. When this property was bought to Select, it was quite lowly geared, so we were able to top it up. This is, I suppose, referencing what Woody spoke about, where the equity release requirements are probably a bit more relaxed than the banks. This particular client was looking to do a bit of property trading, so we could pull some cash out to assist with that. The interest rate on this one was 5.224% for a 2-year rate. This falls into what they call their alt stock product, and so because the client couldn't provide full verification, it was a little bit more expensive. But as you can see, this is markedly cheaper than the 8% the client was paying. So pretty good result overall.
What we have found, as Woody touched on when Kris was speaking to him a bit earlier, is that interest-only terms across banks have gotten a lot more tighter in terms of probably getting them up front, but also trying to extend them overall. Things to be aware of, probably for your own situation, is that interest-only terms don't always coincide with fixed-rate terms. So what you want to make sure is that you're aware of what your interest-only expiry dates are when looking at your own position, because changing from interest-only to principal and interest can be quite a massive jump. Now, with Select, their situation is that they allow you initially up to about 5 years interest approval, but provided you're still within the LVRs and operating your accounts satisfactorily, they will look at extending you for another 5 years as well, where in a current bank market, typically banks aren't being that friendly in regards to extending these interest-only periods. In addition as well, they are happy to do interest-only on owner-occupied properties, whereas banks typically are either not doing that or limiting it to only a few years.
So next part's the pricing. Obviously it's great to have some pretty good product criteria, but if the price is completely out of the market, it doesn't work. Mainly tonight just going to focus on what we call prime pricing. So as alluded to earlier, they have 4 different product ranges: prime, near prime, specialist and specialist plus. Most of who we naturally deal with is going to fall into prime, with a few of you falling into the near prime bracket. Currently how the prime pricing is looking like is like this. As alluded to in the interview, there's a bit of differential on the pricing in regards to the loan to value category that you fall into here. So that was designed because there's some customers who actually have very lowly geared portfolios, but they're struggling more with the affordability side of things. There's other people who, their affordability is fantastic, but they need to push the leverage side. So you can see here the 2-year column is probably the most attractive side. It is worth commenting on the bottom row. You'll see the asterisk there. That is only available for owner-occupied properties. So just like the banks as well, these are current rates. These are always subject to change as well. So I just want to get into a few more funding examples. If you've got any questions, probably a good time to start kind of firing those through, and we can get on to any, I suppose, questions you've got at the end. This was a client who was wanting to buy another investment, and I'll throw this one over to Ryan.
This is a client I was working with not too long ago who had a rental property worth about 400k. It had about 200k of debt against it, and so it was only about 50% LVR. Now, this client was in a situation where through the banks they were struggling to meet servicing criteria as well. So equity, as you can see, probably isn't too much of an issue initially. But what we did work out after having a discussion with them is that they wanted to purchase a property for about 350k. With bank funding not being an option due to serviceability, we had to look at other options for this client in the non-bank space. So what we came up with was probably looking through the scenarios, and even if bank funding was an option for this particular client, the maximum purchase price that they would have been able to get up to was about 240k. And that figure has come up by working at 70% of their rental property and then using that differential as a 30% deposit. The next option was looking at Select. If they were to refinance their existing property away from a bank and top up, that meant that they could get out about 120k of deposit funds. And using that as a 20% deposit, it meant they were able to, if they wanted to, purchase a property up to about 600k. At 80% lending for this particular client, on the 2-year rate, they were able to look at a 5.09%. They were in a position where they went interest only as well to make sure that the cash flow tended to work. Now, where this was a fantastic solution is you had a client who knew their cash flow position and was definitely in a position where they wanted to borrow more and knew they could afford it. In addition as well, they happened to find a really good deal which they were able to get some equity on immediately by purchasing with a discount. So probably looking at some of the bank options out there, the client would have been in a position where they missed out on that equity gain and also weren't able to further their property investment portfolio.
So quick discussion, I suppose, what this funding line is not for. This isn't a property trading product. They're not after short-term people who are just trying to flick deals around. It is the type of situation where if they get customers burning them, they just won't lend to that customer again. It's not really for the development, construction, land banking section. You can use funding from them, however, if you've got a standard security which is not going to be developed, you could leverage against that to release equity maybe for another project, and I'll give it a bit of an example on that shortly. You can't, though, take a property to them, look at leveraging that up and build on the security that you are passing on. This isn't for commercial property at this stage. Did have a talk to Woody a while ago, and it's something he'd like to see down the track, but I don't think that's going to be a 2019 or well into 2020 situation we'll see at this stage. And it's fair to say that they're not very apartment friendly. Basic apartment criteria is they won't lend on anything that's got more than 10 levels. It has to have a minimum square meterage of 50 squares. Ryan did have a situation recently where he was actually able to provide a solution for someone who had a higher apartment. Do you want to quickly discuss that?
Yeah,
don't have it here.
Absolutely. So I had a situation with a client who had purchased a property unconditionally a couple of years back, and the actual apartment itself was on the 14th level, and he was in a situation where, because of how much bank lending criteria had tightened, he wasn't meeting the affordability criteria of banks. So he had plenty of equity, but couldn't complete the purchase through a bank because he couldn't get the funding. Now, what we were able to do with Select is he had a couple of other unencumbered properties which were standard residential securities, and Select was more than happy to take those on board as security, and we leveraged up against those properties to assist him in completing the purchase of this apartment. Now, why that ended up working well was that the property itself ended up remaining unencumbered, and so Select's view on it in that scenario was that while the purpose of the funds was to purchase it, it was the security that they would have otherwise had an issue with, and so therefore he was able to get across the line as opposed to having to sell the property and exit potentially in a different manner.
So keep in mind, if you've got some situations, with probably the exception being property trading, that's something which isn't going to fall in. If you've got lowly geared residential property which is acceptable, there may still be some other way where we're going to be using Select to help you move forward. Another client I've got who falls into this basket a little bit is this particular client. Now I just want to run through this as it's a bit of information here. They purchased an investment property, so they've actually got this one under contract at the moment for 1.15 mil. The subject property's got a couple of dwellings on it. One had no code of compliance. That immediately cancelled out all the banks who weren't willing to look at it. This would also cancel out Select, who also would not be happy to lend on that subject property. What also threw a curveball in is they had a recent job change, and their particular job meant that there was a 12-month probationary period. They were inside the probationary period, so again, from that point of view, no bank funder would be willing to look at it. In regards to the particular project, they were looking at spending about $250,000 overall to complete it, which would turn that into 2 titles, and at completion, and also there's a bit of a renovation on both dwellings, including getting code, and it was going to be worth a touch under the $2 million mark at that stage. They also had a couple $100,000 to throw in. So the way that we actually funded this is the client's starting position, which was their home, not the subject property I'm talking about. Their home was completely fine. Was worth about 1.4 million and had a 400,000 mortgage against it. So about $1 million of equity in there. We took this to Select and geared to 80%, which was basically releasing 720K. Now you would have heard Woody say that 500K was their max equity release. Because we were able to show very clearly where these funds were going, that part was going to be completely fine. It wasn't really just equity release without too many questions. They could see it was going into another purchase. So in regards to the funding of the actual property, it was purchased for 1.15 mil. They were able to throw the cash in there, take away the equity release, and then there was about a $250,000 mortgage that was required to complete that. What we were able to then do is use a secondary asset funder who was more amenable to the security, even though it didn't have code, because they were only lending $250,000 on a property which was actually going to be valuing up over $1 million. Because of the client's probationary period, this particular client was falling into the near prime product. Select were actually happy to fund this client through that period where the banks wouldn't. And once the asset funder has funded the remainder of the renovation, code of compliance has been issued, we can potentially look at taking that property over there. Now, one, I suppose, other point is worth just clarifying, which we haven't spoke about earlier on the webinar, is you can see in this situation that they're more easier in regards to some parts around incomes. I mentioned earlier on the loan affordability side that they're more relaxed. They are also easier in regards to some of the incomes that they're willing to take into consideration. So things like bonuses, commission, child support. Can you think of any others, Ryan? They take
overtime type incomes as well.
Yeah, there's a lot of these. That's much more common these days for people to get income on top of bases. And a lot of the banks will either not accept it at all, or they may margin it by quite a bit. Select is easier on this side. So the combination of them having easier affordability criteria on regards to the loan side, plus maybe taking more of your incomes into account, is really meaning that more clients are able to get across the line.
So it's probably worth, I mean, with some of the examples that we've put on today, not all of them are going to be pretty straightforward, and sitting down and having a strategy meeting might be something that's of use to you if you're looking at potentially figuring out how to continue borrowing where the banks have said no, or even looking at extending things like interest-only periods. Feel free to get in touch, and we can have a strategy meeting to figure out what may be next for you.
As I said earlier, just very, very clearly, there's going to be some of you who'll come along who may want the Select product, who we might be sitting there going, it doesn't fit, we need to recommend another non-bank product. Also on the flip side of that, however, understand we're always going to be using bank first as a recommendation unless there's a really marked benefit for you to go to Select or another non-bank lender, and that reason is obviously built around price. So we've already had a couple of cases of clients coming to us thinking that they can't get bank funding, and it's purely the bank that they have been potentially talking to themselves who won't play ball, and which has been a case of us going, well, actually you'll be able to get this through this other lender over here because they are going to assess you a little bit differently. So feel free to kind of come have a chat.
Some really great information there, wasn't there? I'd just like to say a really big thanks to Kris and Ryan, both from Kris Pedersen Mortgages, for sharing that information and showing us some of the advantages and benefits that working with a non-bank lending product such as Select can, offer us as residential property investors. So depending on individual people's situations and how you make your income, whether you're self-employed or not, whether you have any strikes against your name with bad credit, etc. A lot of those types of people just straight away think that they won't be able to qualify for, standard bank lending. And that may well be the case, but there's always other types of options out there. And this day and age, with a quality non-bank lending product such as Select, it doesn't come at a huge premium over and above standard bank interest rates. Which is absolutely great. We're always trying to push the envelope as property investors. We're always trying to leverage our available, capital and equity as far as we can. So we want to be able to borrow to, 80% LVR rather than 70, or we want to be able to borrow, have a more advantageous debt service criteria with the lender we're working with, so that they will lend us, more money than what a main trading bank might. So all of those things are big pluses, and there's definitely a really great place for this type of lending product in our New Zealand market. If you have any further questions about this lending product or this type of lending, please feel free to ask the question down below, depending on how you're watching this video. If it's on YouTube, you can ask a question below. If it's not, you can contact us via our contact us page, send us an email, reach out to us, ask your question, and either myself or Kris from Kris Pedersen Mortgages will be able to come back to you and get you sorted out. All right, guys, that's all from me for now, and I'll catch you on the next video. Cheers.